Global growth concerns, they're still on the minds of investors, however. Yesterday, we were able to speak to Marc. He was sounding off on the trade war impact with China as one of the reasons the markets have been a little choppy. Take a listen to this.
The interesting thing is, if you talk about China trade war, the trade deficit that the U.S. has with China is growing. It's not shrinking. If you look at the numbers for 2018 versus 2017, it's a larger trade deficit. So I don't see any big changes taking place because of this so-called trade war.
All right, joining us now, Federated Investors Client Portfolio Manager Jordan Stuart, along with Bannockburn Global Forex Chief Market Strategist Marc Chandler. Jordan, let's start with you. Your take on this.
Look, I think the market for some time has been pricing in a slowdown in growth. There's lower rates that are coming our way. In our opinion, that creates opportunity for growth companies. Companies that don't need economic growth, don't need super high rates to work. Secular growth companies that, as the previous guest was talking about before, that are changing the way we live, that can control their own destiny and through technology create their own earnings and revenue growth.
Marc, do you think that the fears about global growth slowing are a little exaggerated when it comes to the impact that we're seeing in the market? I mean, it's not like the world is coming to an end. It's expected that growth will slow a little bit, and even in China, it's a marginal slowdown.
Yeah, so I think a lot of the slowdown is looking in the rearview mirror. I think that we know that something bad happened in Q4 last year when the stock market sold off, but also thinking about spilling over into Q1 this year. It looks like the U.S. economy probably came close to stagnating. We had the government shutdown, the cold weather, all this really froze up activity.
But part of that was the Fed, too. I'm sorry to interrupt you. That was really, a lot of that had to do with Jerome Powell versus the concerns about China, Apple, those, were definitely out there. But the Fed has backed off. So all things equal, the market should stabilize.
Well, yeah, I don't know. I kind of think that the economy should stabilize. This drop in yields, we were talking about this before, we've seen about an 80 basis point decline in our 10-year yield since September. And I don't think this is all the Fed, because there's an interesting thing that happened at the end of last week. For the first time in almost 3 years, the German yield on their 10-year Bund went negative. The Japanese 10-year yield is negative. So I think that lower yields overseas, negative yields, right now we're looking at something like $10 trillion in negative yields. I think this makes the U.S. 10-year Treasury look more attractive regardless of what you think the economy is doing.
Do you agree with that point of view, that the yields around the world sort of are going to create a situation where, obviously it's all interrelated, right? And it's impacting our market, but the inversion of our yield curve, it's causing a lot of alarm.
I think these macro concerns create opportunities we've seen the last 7 or 8 years. The market starts to price in 5 or 6 different recessions during this recovery. There are still companies like the FANG stocks, like the IPO market that's coming, that are changing the dynamics of our economy, and that whether there is a slowdown and then we're going to pick back up, that there's secular growth out there, and this is probably going to create some opportunities.
It's not just the United States relationship with China. It's not just slowing growth there and also ongoing negotiations and trade talks. It's also China's relationship with Europe.
Yeah, so here's what I think is really happening in the big picture, is that I think that there is a new Cold War that's begun between the U.S. and China. And the trade negotiations is only a small part of it. Look what the U.S. did. It recently, for the first time in several years, sent ships through the Straits of Taiwan. We're trying to encourage Europe to not use a particular Chinese hardware provider. So I think that this is a multifaceted development, and like the first Cold War, the second Cold War is battle over Europe. Europe doesn't have the national champions that can compete with the U.S., China, or, last year India became the 5th largest economy. This year it's likely to surpass, 6th largest economy, likely to surpass the UK this year. The world is changing and Europe is not able to compete. So I think that the battleground for this Cold War is Chinese influence into Europe, and that's beginning this week. There's an EU summit later this week with China. China just bought, I think it was $35 billion worth of Airbus planes, and some of the ones that compete with Boeing.
Yeah, no, we talked about that earlier.
China is playing, China wants to take Europe away from the U.S., and the U.S. is doing a good job of pushing Europe away. President Trump is talking about not just charging our allies to house American troops, but he wants the 50% cost plus 50 is the mantra. So we are doing a lot of things to frustrate our allies at the same moment in time where China is doing their best to pick them apart.
All right, final or two, Jordan, real quick.
Yeah, look, I think there's plenty of opportunities. This similarly reminds me of Japan was going to take over, and Russia had an edge on us. The United States, we have the best innovators, the best companies out there that we're going to plow through this. We'll see what happens with the geopolitics, but I feel that there's still upside for stocks given this environment.
Gentlemen, great to see you both. Thank you so much for coming to see us in our new studio, which I keep touting because it really is just so beautiful and it's gorgeous. Great to see you. Thank you.